Hi, I'm Jenny Brown. Welcome to this week's MFB News. I hope you are all really well and you've had a good week. What have we got for you today? So first of all, we're going to be covering off the latest lender news, as always, letting you know what those lenders have been up to in the last 7 days. We're also going to touch a bit on what's going on with swap rates and what this means for 2-year fixed rates at the moment. We're then going to talk about what's been happening with UK inflation, how this is going to impact interest rates going forwards. Incidentally, the Bank of England base rate meeting that was meant to happen yesterday has been pushed out by a week, so it's happening next Thursday, obviously in mark of respect for the Queen's funeral. And then lastly, we're going to be looking at the latest news on house prices based on data that has been released from the Land Registry. Okay, so in the last week, we have seen more lenders putting up prices, I'm afraid. First of all, we've seen Precise Mortgages withdraw all of their products and reprice. Their rates are now starting from 5.24%. Precise are a specialist lender, so, you know, I say this all the time, but HMOs, multi-units, limited companies, no maximum number of properties in the background, no minimum income requirements, all those kinds of things. So 5.24 is your new pricing there. Incidentally, Kent Reliance didn't have any 5-year fixed rates. Kent Reliance Precise are part of One Savings Bank. So One Savings Bank is the kind of umbrella company, and then there's various lending arms within that. So Precise is one of those, Kent Reliance is another. So often what you'll see when lenders have these kinds of structures is that when one changes, they all change, either side by side or one after the other. So what we've seen in the last week is that Kent Reliance only had 2-year fixed rates available. They've withdrawn those and they're about to reprice and bring out some new 5-year fixed rates. Kent Reliance as a brand is the more complex lending arm, so Precise deals with the more kind of straightforward, albeit specialist buy-to-let. Kent Reliance, the lender who's much more manual underwriting, could look at more complicated cases. So as an example, they can consider minor adverse credit. They're only taking personal guarantees from directors, not shareholders, which means that that leaves some negotiation for slightly more complex shareholding structures and limited companies. They can consider larger HMOs and blocks and flats than Precise can. So more of a specialist lender than Precise are. And to this end, what this means is that when their rates come out, they're going to be more expensive than Precise. With Precise is starting from 5.24, that will give you a pretty good indication about where Kent Reliance are going to be sitting. Now, we've seen the Coventry Building Society withdraw some of their 5-year fixed rates. The way Coventry work is they will offer rates which are very low, but have a £2,000 arrangement fee. Ones that are a bit more expensive with the £1,000 arrangement fee, and then ones that are more expensive still but have no arrangement fee at all. What they've done is withdraw some of their 5-year fixed rates with the £2,000 arrangement fee. We've seen Clydesdale mortgages increase their rates, and these are now starting from 4.05%. Clydesdale, 4.05, you'd be forgiven for thinking they're a specialist lender. They're not. Clydesdale, just talking about sort of like lending families, is part of the same group as Virgin, or owned by Virgin now. So Clydesdale, so what they are as lenders, they are a lender that manually underwrite. They lend to individuals only. The way that they kind of come to their own, so they're able to look at complex income structures, and when they're looking at buy-to-lets, they're doing an overall affordability calculation. So the rental calculation that they offer is actually incredibly generous, but that's because they're looking at your overall affordability in the background. So what we find is with Clydesdale is that actually they're really good for people who are high income earners, only have probably 1, maybe 2 buy-to-lets in the background whose rental income isn't working out, and therefore when Clydesdale's looking at the client's overall income situation and debt, then the numbers tend to work really well. So it's quite a limited appeal. It only works for a handful of people, but actually when it does work, it actually can be a bit of a lifesaver, if I'm honest. Now, Principality have withdrawn some of their products. Vida have increased their pricing. Their pricing now starts from, embrace yourselves here guys, 6.39%. That does feel incredibly high compared to their peers, but when we talk about swap rates in a minute, that you'll start to understand why maybe it's not so crazy after all. We've also seen Fleet Mortgages make some changes to their product set. So their 5-year fixed rates at 75% loan to value, pricing is from 4.95. They haven't actually made any changes there just yet. What they have done is introduce some 5-year fixed rate products at 65% loan to value, which are starting from 4.85. They've also got green products, which means there's a discount of 10 basis points off the actual interest rate. They've also increased the headline rates for their 5-year fixed rate products at 80% loan to value. So their pricing here is now from 5.19%, so a bit of jigging around. Now lastly and interestingly, what they have done is remove their 2-year fixed rates. from their product set, and they're not the only lender that's doing this at the moment. And what they've said is they've done this as a result of 2-year swap rates increasing rapidly and therefore leading to an uncompetitive price situation for 2-year rates. So they've withdrawn all of their 2-year fixed rates, both on sort of standard, new to them business and also product transfers. So I really want just to go dovetailing quite nicely into this is talk to you a bit about what swap rates are doing at the moment. So 2-year swap rates are as high as I can remember for many, many years. They're currently at 4.015, and that was as of about 7:20 this morning. 5-year swap rates are at 3.603. So you can see the difference here. So it's really unusual for 2-year swaps to be more expensive than 5-year swaps, but they're actually just under 0.5% more expensive at the moment. So the lenders are saying, crikey, well look, if we need to make a 2% margin, on a 2 to 2.5% margin on swap rates on cost of funds, and 2-year fixes are at 4.015. That means we're going to have to offer 2-year fixes at like 6.5%. Then throw into the mix the rental calculation and numbers stacking up. It just doesn't make sense. So at the moment, there are quite a few lenders who are pulling their 2-year rates. Now, just carrying on with the vein of swap rates for a moment. So 5-year swap rates at the moment, as I mentioned, were 3.603. That's up 1% from this time last year. This time last month, and over 3% higher than they were this time last year. So if you're in the kind of market for a mortgage and you're looking at the price and you're thinking, God, these are really expensive, just keep in mind the reason behind this. So at the moment, the cost of lenders essentially bringing money in to re-lend out to you has increased by 3%. That's going to have to get passed on to the borrower to some extent, and that's why we're seeing such a high increase in mortgage rates at the moment. Now, just carrying on with that slightly, so LendInvest have also withdrawn all of their 2-year fixed rates as well, so just like Fleet have done. What they've also done is increase all their remaining rates by up to 1%. So their pricing now starts from 5.09%. Now, in terms of where that leaves us, so where are we? So in very short terms, personal straightforward properties, 5-year fixed rates are now starting from 3.1%, and limited company 5-year fixes are starting from 4.69%. We are definitely seeing more landlords asking about variable rates because these are significantly lower actually than fixed rates at the moment. A lot of people are saying, well, actually, my kind of expectation is that interest rates are only going to increase by another 0.5%, for example. The variable rate is, 1.5% cheaper than the 5-year fix, so I'm going to take my chances on that. I think realistically, only the passage of time is going to tell you if you did that, whether that would have been a good idea or not. But there definitely is more of a kind of argument for considering trackers now than there has been for many, many years. Okay, so the latest annual inflation figures have been released. It's interesting. I think there's so many people who haven't really had to think about inflation. It's not something that often gets talked about, and now I think it's a word that we've all become incredibly familiar with, which is just really a sign of the times, I suppose, isn't it? Now, look, the latest annual inflation figures have been released. So there was an unexpected fall, actually, to where inflation fell to 9.9% in August, which is down from the 4-decade high of 10.1%, which was recorded in July. Now, according to the ONS, the Office of National Statistics, a fall in the price of motor fuels made the largest downward contribution to the change in the Consumer Price Index annual inflation rates between July and August 2022. However, what they've also added is that smaller partially offsetting upward effects, so a counterbalance essentially, came from price rises for food and non-alcoholic beverages, miscellaneous goods and services, and clothing and footwear. Now, this fall in inflation slightly eases the pressure on the Bank of England, which has hiked the base rate 6 consecutive times since mid-December in an effort to control soaring inflation. So many experts still believe that another interest rate is coming rate increase is coming next week, as the UK central bank has predicted that inflation will rise even further to 13%. Now, in terms of where the kind of school of thought is in terms of what's going to happen with interest rates next week, there are people talking about 0.5%. Actually, there's also people talking about 0.75% as well. Whether that will happen, I don't know. I was listening to some data that was released this morning in terms of consumer spending. The high street has seen a decline in sales, or retail rather, in the last month or in August. So actually things are starting to show signs of people really slowing down. Obviously the inflation figures because of the cost of fuel easing is a good thing as well, but fundamentally in terms of keeping the pound up with the dollar, we may need to increase interest rates simply to keep up with what the Fed are doing in the States. So I think it's just a case of watch this space for next week, but I think one way or the other that an interest rate increase next week is on the cards. So it's not if, it's just simply by how much. And like I say, some people are predicting up to 0.75%. Land Registry have released their latest data on house prices, which showed that house prices grew by 15.5% in July, which equates to an increase of circa £6,000 on average per property in the UK. So this took the average price of a property in the UK to £292,118. And I think really the question in everyone's mind is how much longer can this continue for? The housing market is remaining incredibly robust. I think there was a lot of expectations that things would have slowed off and started really almost going backwards by this point in the year, but actually things are actually showing such signs of continuing to increase. Now there is a kind of school of thought which is saying that actually with house prices going up, with the challenging economic outlook, recession expected by the end of the year, household finances are getting more squeezed, and not only that, but also renters are facing steeper rents and household bills as well. There is a real school of thought that actually with all the uncertainty and affordability pressures that the housing market is going to essentially cool right off by the end of this year and into next. There's still no real expectation for house prices to go down, just the growth or rate of growth rather, just to slow right down. And so actually we're looking at in 2023 a situation of no house price growth or minimal house price growth. But when you read all of the predictions across the various economists and industry experts, very much not expecting house prices to fall off a cliff. But there you go, another month goes past and another month of house price growth. And that's everything for me this week. Sorry, I feel like a real doom and gloom merchant at the moment. There's actually loads of really good stuff to report as well in terms of what landlords are doing. We're seeing a notable shift in terms of landlords' kind of activity. So obviously people are remortgaging, that's a given at the moment. While I'm sitting here saying, the rates are 5.09%, which sounds probably really expensive, particularly if you're coming off a much lower interest rate, or indeed you were reviewing your options even a few months ago, comparatively to how much more expensive things have become. But actually some people are still facing the possibility of going onto a standard variable rate of up to 7.5%. So actually when you kind of put it into that sort of context, then these rates don't feel quite so bad. Now, the other thing I'm saying is that we're seeing different kind of behavioural activities from landlords in terms of their investment choices. So landlords are certainly turning their minds back to yield. When we find cash flows are being squeezed, that's the kind of way their minds tend to go. So we're certainly seeing an increase of landlords looking at high yielding properties, so HMOs and multi-units, 100%, definitely an uptick on that. But also the other thing we're seeing is landlords revisiting the concept of refurbishment properties. First of all, because they offer real value. They give the landlord an opportunity to show an uplift in capital very, very quickly. But also because it means they can essentially refurbish the property and get it into an EPC rating of A to C in readiness for the MEES changes in 2025 as well. So it's kind of like, well, look, if I'm going to buy a property and spend a bunch of money making it greener, I could also just do a refurb at the same time and it all kind of loops in quite nicely. And actually there's some really good mortgage products available to support these kinds of projects. So if you are thinking about doing something slightly different in terms of your kind of investment class or actually taking on a refurb project, we do loads and loads of these. We're really good at these, so do give us a call, we'd be very happy to help. But that's it from me, so thank you very much again for watching and for your time. I will be here same time next week. If you do have any questions, do give us a call or have a look at our website, mortgagesforbusiness.co.uk. I will see you same time next week.